Imagine the scene. A night in China, a bustling metropolis. In the square stands a giant train station. Glass, steel, neon signs. Dozens of high-speed expresses are scheduled. White trains rush along the tracks at bullet speed. But if you look inside, you'll see emptiness. Cars are almost vacant, while guards lazily check tickets, knowing the flow barely pays for the electricity. This is the symbol of modern China. A country that only yesterday dictated the pace of global development now balances on a knife's edge. Officially, the world's second-largest economy. Unofficially, a giant on clay feet, steady only until the debt tower began to sway. Total debt, more than $50 trillion. A figure dizzying even for Wall Street traders. Behind it are not abstract numbers, but concrete shadows of mega projects, dead skyscrapers, empty stations, millions of apartments where no lights ever turned on. This nation once built faster than cameras could blink. Whole cities sprang up in just a few years, but now they stand abandoned, like sets from a disaster movie. No one lives there, only the wind scatters dust along deserted boulevards. But the scariest part is not the numbers themselves. The scariest part is the domino effect that the collapse of China's growth model could trigger. For China is no isolated island. Its factories, construction sites, and trade lines stretch into every country, every market, every supply chain. And if the giant stumbles, the shockwave will ripple from New York to São Paulo, from London to Sydney. How did it all begin? With an ambitious dream. After the global crisis of 2007, Beijing decided not to wait for the economy to revive on its own. Instead, China drowned it in concrete and steel. Billions went into mega projects, from high-speed railways to brand new cities meant to symbolize the miracle. The high-speed rail network grew like wildfire. Where yesterday only one slow train crawled, today a gleaming white express sped by at 350 km/h. By 2025, China boasted the largest network in the world, 50,000 kilometers. Journeys that once took a day could now be done in just a few hours. But with the record came the bill. The total cost of the network topped $2 trillion. Ticket revenues weren't enough to even keep the lights on, especially in poor provinces where trains ran half empty. And where passenger flows were a bit higher, tickets still proved too expensive for local residents. That was where the first crack appeared. It seemed China had everything: speed, scale, ambition. But beneath the shiny facades, rust was already spreading. In 2011, disaster struck in Wenzhou. 2 high-speed trains collided due to a signal failure. 40 dead, nearly 200 injured. The investigation revealed a grim truth: haste, design flaws, even counterfeit materials. In an instant, a glittering symbol of modernization became a monument to human greed and the race for records. After the tragedy, projects were frozen, sections rebuilt, safety systems overhauled. Costs soared even higher. But this was only the beginning. Alongside the railway boom, another bubble swelled: real estate. Developers erected complexes faster than people could move into them. Millions of Chinese poured savings into apartments not to live in, but as a concrete bank. Everyone was sure prices would rise forever. The state played along, selling land at inflated prices, using the proceeds for roads, schools, hospitals. It looked like a perpetual growth machine. But every bubble bursts eventually. By 2021, reality hit hard. More than 60 million empty apartments. Developers' debts did the hundreds of billions. The legendary Evergrande collapsed first. Country Garden followed. Huge construction sites froze. Cranes fewer than promises. And cheated homebuyers declared a mortgage boycott. We won't pay for what doesn't exist. That was when the first mass protests of the middle class erupted. People who believed in the Chinese dream, left only with debts and concrete shells without windows or doors. And then, another crack. In 2023, one of the country's largest trust companies, Zhongrong Trust, collapsed. Tens of thousands of investors were left with nothing. Their money burned like matches in a bonfire, and with it, trust went up in smoke. The locomotive that had raced full steam ahead only yesterday suddenly found itself in a fog of debt. And the more authorities tried to hide the smoke, the more it seeped out. Beijing officially admitted regional debt loads had spun out of control. But instead of letting the system cleanse itself, the center poured in more money. In 2025, the government issued bonds worth 500 billion yuan, almost $68 billion, to support struggling banks. The People's Bank of China cut interest rates several times and lowered reserve requirements. The system seemed to breathe again, but it was like putting an oxygen mask on a patient. Not treatment, just delay. And regional authorities went further, borrowing through semi-state LGFV funds, creating black boxes where debt piled up outside official statistics. By mid-2025, these hidden debts had reached $12 trillion, and no one really knows how to repay them. The debt tower kept rising. When a tower of debt trembles, the ripples are felt not just nearby. China is too big to fall quietly. Markets worldwide began to ring alarm bells. Investors who for years bought Chinese bonds and poured billions into developers started pulling money out. European insurance companies admitted losses of hundreds of millions. Funds cut positions. Trust evaporated, and in nations that lived by exporting to China, the crack echoed. Australia, Brazil, South Africa. Falling shipments of ore and copper hit miners, ports, tax revenues. The Chinese motor slowed and the wave rolled into working-class neighborhoods on the other side of the planet. Ordinary Chinese felt the ground shifting too. Cement and furniture factories closed. Thousands of construction workers lost their jobs. Housing prices in major cities dropped by 20%. Apartments once seen as golden assets turned into concrete traps. People stopped spending, domestic demand collapsed. And all this unfolded under the watchful eyes of Washington and Brussels. The West worried. If Beijing tried to revive exports through a sharp yuan devaluation, Chinese goods would become cheaper and more competitive. But that could ignite a new trade war. The world realized China's problems are not just China's problems. If the country's banking system starts to collapse, the effects will reach every supermarket and bank on the planet. Shelves will empty, electronics and cars will soar in price, resource economies will lose their key buyer. To understand how China fell into this debt trap, rewind. Since the early 2000s, Beijing built on a three-pillar model: build, produce, export. Any global slowdown was offset by domestic construction and mega projects. After the 2008 crisis, the bet on concrete and real estate became absolute. Local governments sold land to developers at inflated prices to fill budgets. Banks lent generously. Developers built. People bought apartments in bulk, 2, 3 at a time as if they were stocks. Faith was simple. Prices will always rise. But baked into this model was a time bomb. Everything depended on constant debt expansion. As soon as land sales slowed or banks tightened lending, the system began to choke. In 2020, authorities tried to impose order with the 3 red lines: limits on developer borrowing. But instead of stabilizing, the system cracked. Giants collapsed first. Evergrande with more than $300 billion in debt. Then Country Garden, and the chain reaction spread. The second vulnerability, mega infrastructure. China Railway Group loses up to $20 billion annually maintaining unprofitable lines. These loans were state-guaranteed, turning loss-making routes into a heavy burden. The third problem, hidden regional debt. LGFV funds became black holes where billions vanished. By 2025, over $12 trillion had piled up. No one knew how to service it. And finally, the fourth, global dependence. China became the world's factory, but that meant any domestic recession hit supply chains in Europe and the US, resource exports in Australia and Brazil. When the locomotive slowed, the entire global network slowed with it. The debt tower became a global threat. When smoke fills a room, you can open a window, but when the whole house burns, windows won't save you. Beijing understood this. Over the last 3 years, authorities tried everything to stop collapse. What did they do? Cutting rates and boosting credit. The central bank slashed key rates, reduced bank reserve ratios. Briefly, mortgages picked up, companies borrowed. But fear killed momentum, buying unsold housing. In 2024, the government spent 42 billion yuan, about $6 billion, buying up stuck apartments. But with 80 million empty units, it was a drop in the ocean. Refinancing regional debts. Shadow obligations were converted into official bonds. Transparency improved on paper. In reality, debt just shifted, weighing heavier on budgets. Betting on new tech. Beijing pushed EVs, batteries, AI. Companies like BYD expanded into Europe and Latin America, but faced tariffs, probes, accusations of unfair subsidies. The drive stumbled. Yes, tech created jobs and exports, but nowhere near enough to replace the 1/3 of GDP once fueled by real estate and infrastructure. So the metaphor haunting China now is a game of Jenga. Every new loan, every bond is another block stacked on top. The tower still stands but wobbly, each move riskier than the last. Yes, China has reserves, an industrial base, crisis experience, but every new billion poured into old projects makes the future more hostage to the past. And worst of all, trust is gone. People no longer want to buy concrete that might stay empty. Liquidity pumped into banks doesn't turn bad assets profitable, and without trust, no economy revives. Today, China holds the system back from immediate collapse, but it looks less like a strategy, more like a man bracing a crumbling house. One hand on the wall, the other holding the ceiling, a foot against the door. No one can stand like that forever. Now, China stands at a crossroads. On one side, massive reserves, industry, crisis management skills. On the other, a debt pyramid growing faster than incomes. Every bond, every bailout is just delay, and the whole world holds its breath. Why? Because a Chinese collapse won't be local. It will be a shockwave across continents. Finance, funds, banks, pensions will shake. Trade, store shelves will empty, electronics and cars spike in price. Resource economies, Australia, Brazil lose their buyer. Politics, a yuan devaluation could spark a new trade war. In an age of global interdependence, every crack is systemic. For decades, China's economy was a growth machine. It lifted hundreds of millions from poverty, became the world's factory. But today that machine runs on fumes. The fuel is almost gone. The engine sputters. The metaphor is simple. Jenga. The tower still stands, but it trembles. The question isn't if it falls. The question is when and who it will crush beneath. For Beijing, time is the most precious resource, and it's running out. For the world, that's the deepest fear, because in global turbulence, there are no spectators. Everyone is a participant. So next time you pick up a smartphone, glance at a price tag, or read about the markets, remember, cracks in China's debt tower may be closer than they appear.